everybody. Let's see if we can hear each other. So hi, I'm Mary Liu. I'm an associate at Bertelsmann Digital Media Investments. I'm excited to share and see what the SheWorx community has in store today. Check. So I have the chat pulled up. We have items to discuss today about navigating the early stage. I'm happy to be interrupted. Really, this is for you to see, what works best for early stage founders and if venture capital as an as something makes sense. So just to get started, I'll introduce myself. Hi, Mary Liu. I'm with Bertelsmann Digital Media Investments. We are an early stage seed, Series A, Series B fund focused on mainly digital media investments, but that covers a broad category of companies that deal with video, content, branding, technology, plus the media ecosystem. In addition to that, we've rolled up some frontier tech focuses such as virtual reality, chatbots, audio, and currently content space. So it's a pretty broad category, and we do a lot of seed investing as well. One unique thing to mention is that we have a single LP and we're set up like a fund rather than off-balance sheet investors when you typically encounter strategic VCs. So Bertelsmann is our parent company as well as single LP. They are one of the oldest media companies in the world, and they are about $20 billion in annual revenue, and we are there in some sense where we try to bring together a community of entrepreneurs that makes sense in terms of Bertelsmann's operating divisions, but we as a team are financially incentivized to then align our incentives with the entrepreneurs we meet. I'm happy to go further into that as we go into the third topic today, but mainly we'll cover first and foremost, how do you approach that stages without so much of a network and with a very fledgling product. We'll touch then into the differences between a convertible note and an equity round and what that means for the early stages of your fundraising. And then lastly, we can enter into some of the interesting terms you should watch out for that are unique to corporate VC world and the differences between a financial VC and a corporate VC. So just before I get started, I'm going to give a couple seconds for any questions to come in. I have the group chat pulled up, have the Slack pulled up, and honored to be here as part of the SheWorx community. It's always a pleasure working with Lisa and Yin, and thank you all for setting this up. A couple seconds here. Great. Well, just to dive in, well, again, so excited to talk about the most and least effective ways to reach out to investors. I'm Mary Liu, an investor at Bertelsmann Digital Media Investments, and we do seed, Series A, Series B funding. So that's check sizes from 100,000 to 5 million in the initial round, depending on your stage of the company. So just first and foremost, you probably have heard about this, but the best way to get in touch is through a warm introduction. That's really just not even your foot in the door, that's just turning the knob. Because what you do after that is so important in the process of working with your investor. It's A, about developing a relationship, and B, understanding that as you go earlier, there are less numbers and less the investor to evaluate, so they're honing in on the evaluation of you. So that process begins with your first email to the investor and a reply. How you manage your fundraising process is very indicative to us as investors of how you manage your company and how you manage a sales cycle, for example. Because if you can't articulate your mission to us, it's going to be hard, we believe, that for you to articulate then effectively your mission to the outside world and your customers. So managing that fundraising process and the communication is very key to establishing that first level of trust. And that level of trust is what is so important at the earlier stages because, again, there's a lack of numbers to evaluate and consider about the investment process and the diligence process for early stage founders. I'll give a couple of questions, seconds here for additional questions to roll in. Just checking your Slack channel and seeing what, and if anything. And feel free again to interrupt me. I'm Mary Liu at Bertelsmann Digital Media Investments, and see how we can be helpful as investors to the community that's SheWorx. So just to take a step back, I've talked a bit about how to approach an investor, but, is venture capital really right for you? And that is a question I sometimes bring up to early stage founders that approach me when they're trying to raise their first institutional round, and perhaps they haven't even taken angel money yet. And here's where I like to emphasize that venture capital is not the right path to everyone who wants to build a business. Just in a rough delineation between a cash business and a scalable software business, for example, a restaurant without any tech-enabled platforms underneath it is very much a cash business, because if it stops operating today, the cash flow stops today. But software that's scalable is a different approach, and you can build the software and then continue to scale the initial fixed cost invested into the next couple of years, pending any modifications you make to the software. But those are the types of businesses that venture capital funding would be able to take far because of the risk profile of investors. So understanding whether or not you want to jump on the express train, that is the VC route, or taking it slow at your own pace through other avenues of financing. And while we won't touch on those other avenues today, feel free to reach out, just to discuss why taking out a loan might just be a better avenue than taking venture capital funding. Dealing with VCs is a whole other world of managing relationships for your board, for the future. And if this isn't your first company, the way you deal with VCs initially will establish your reputation and will be carried forward as you continue to either build this company or become a serial entrepreneur. And so now I'm just giving a couple seconds for questions again to roll in. So in terms of further understanding just how VCs are looking at things in the earlier stage, when you approach them, it's very important to have that pitch down and not, if you indicate that you're still questioning your product or questioning your mission, it's tough for an institutional seed investor to come in. And I usually recommend founders who are still thinking through their product to get strategic angels to come into the round, and do a friends and family round where angel investors could also be a part of what they're doing. It looks like so I just got a question from Antoinette Forth. Hi, Antoinette. The question is, once you have a warm introduction, do you recommend an in-person meeting versus video for a software company? I think regardless of the company, an in-person meeting is always best, just strictly better in a sense, because again, the trade-off on an earlier stage company is we just don't have the metrics to evaluate what you're doing. And meeting you in person is so key to develop that relationship. And not only does meeting in person help you with me as an investor, I can then foresee what would help you with other introductions. And this actually brings up a good point. If you're on the West Coast and I'm on the East Coast, based in NYC right now, and it's tough for you to come out here. Video is always better, of course, but I could say if you can gather an in-person meeting, that's just strictly better. In terms of interacting with VCs on the West Coast, East Coast, it's actually interesting to understand the dynamics that are different. So East Coast investors tend to be more collaborative. The reason being is that the fund sizes are smaller. So if you have a $100 million, $200 million fund, you tend to co-invest with other investors, because then in the follow-on rounds, you have the further capital support from other investors to continue to support the life cycle of the company. On the West Coast, you'll see the larger funds who have raised $1 billion fund in their most recent fundraising. So investors also fundraise themselves from LPs, limited partners, and those funds will want to take the whole round generally. So you'll see a more competitive landscape there. I know that's a tangent to Antoinette's question about in person versus not in person, but it's a driver of the relationship and how you should think about even yourself politically of managing your investor relationships across coasts depending on where you're fundraising. I hope that's helpful. So in terms of the next section, and feel free to come back to this topic if you have further questions, but one of the other things I want to touch upon today is the convertible note versus a price round. I know there's a lot of discussions around this. I think SheWorx has held a really great breakfast with sort of leaders in New York City about the differences between these two. But just to start, what is a convertible note and why? In my opinion, I think it's a better option for early stage founders. So convertible note is a debt instrument first and foremost that will convert to equity upon later date, what's called the maturity date. And if it's triggered, it'll only convert to equity if it's triggered by another equity round of financing. If there is no equity round of financing, it's just a layer of debt on your company, and the investors do not own any equity in your company until it converts. So all you have to do to get your investors off your back is pay them back. But hopefully, as you establish your investor relationships, you want these people as a part of your company, and hopefully they're helpful enough so you want them to continue on with your company. One of the things to emphasize here is that the convertible note as an option is much cheaper to negotiate in terms of your time, and much cheaper on the legal side for fees. They're much simpler terms than a price round, and you'll likely face less dilution now, even though the caveat on the note is the most important element on the note from the investor perspective is the valuation cap. So as you're thinking about your note, typically the other terms are pretty standard, you know, a low interest rate, a maturity date, but that valuation cap will set the floor of what the valuation will be in your next round. So if I encounter a company with a very low valuation cap, say 5 million, I then have the indication in my head that that is what the previous round of investors thought that the company might at least be worth in the next round. And if I want to price up the company, I wouldn't want to pay up and increase that valuation 2 times to 10 million, for example, if I know that the investors in the previous round will be happy with the conversion with a round at 6 million where they convert in at 5 million. So those are some of the factors to decide. I know the terms can get a bit seemingly complex, but at the end of the day, the reason between convertible note and price round is all about the trade-offs and the complexity of your relationship initially with your investor. And just pausing here a bit, just to wait for questions. So I know this topic is a very interesting one to sort of debate, and I think there's different perspectives often from founders who have seen different avenues of success with these. One of the aspects of convertible notes that's been interesting that has progressed is you can now do what's called a safe or a KISS. So if you're thinking that a priced round where investors determine your valuation is too expensive, whether it's from the legal side or whether from your time side in terms of complexity, because again, a priced round will take a board seat, there will be different redemption rights, there'll be different rights that investor will lay on top of the price round because you're offering preferred stock. And you know, I can go into a whole series of what are the things you look out for in terms of participating preferred, liquidation preferences on that side. But not to jump off on too much of the tangent, I had just mentioned again that there are ways to structure convertible note that Y Combinator and 500 Startups are helping out with. So that's called the SAFE or the KISS. And the SAFE, I'm just going to finish this point before answering Emily Lisfield's question. The SAFE is a simple agreement for equity developed by Y Combinator that is not a debt instrument that presents a much easier avenue of terms because there is no maturity date on a SAFE and there's no interest rate for you to have a standardized template with your investors. The KISS is a 500 Startups developed note that has some default terms in it. KISS stands for Keep It Simple and Safe. Instrument, and these have some default terms that allow you to have an anchor of what to expect. Oftentimes I hear founders asking, what are some of the terms that I should be asking for? Because it's tough to anchor what you want without a relative comparison to other companies, and KISS tries to solve that. One caveat here, I just want to mention, when terms become simple and you have a template that you're building off of with an investor, we've seen this when we're investing in safe notes. We then maybe want a pro rata right, which is the right to invest proportionally the stake we put in this round and the equity in the next round through the safe note. So the more insidious side of keeping it simple is that you might have to develop side letters with your investors. So this is the nuance of the convertible note. So yes, it's simple and it may save you the negotiations today, but as you think through the terms, it could just be as onerous as the equity side of things if you're not aware of some of the unique nuances that investors may ask for on a side letter, for example, which is perfectly legal. And happy to touch base on this some more. And again, I'm Mary Liu from Bertelsmann Digital Media Investments. We're an early stage seed and Series A, Series B fund, doing mainly digital media, but we cover a wide range of media and technology companies. And we're happy to talk more about some of the investments that we're pushing out into, such as blockchain, chatbots, VR, AR. So just to sort of address Emily's question, she asks, how do you build out a strong business plan when you don't have a valuation yet? So I would, ask for some clarity here, but what I think the spirit of the question is trying to ask is, how do you move forward with building out your product roadmap or your execution when you don't have a valuation today? That can then, again, I guess, help you determine how your business should grow into in the next round. It's tough to say that you should be underpinning your product roadmap to your valuation. I don't think these two things should be conflated. When you think about the valuation that you're setting for your company, I would think more so on dilution and what industry you're in. And depending on what sector you are in, the valuation expectations from the investor side could differ from, if you're in, say, virtual reality versus e-commerce, because the multiples there that investors are paying on the valuation are different because of the expectations of the growth of those markets and the competition existing in that landscape. In terms of understanding how to build out a business plan, I don't think that should be tied to what the investors see as the value of your company. Oftentimes you'll get a lot of push and pulls from everywhere, from whether it's your family or friends, from your investors, and it's dangerous to really anchor your vision to one or two people, or even to dilute your vision based upon the push and pulls of everybody around you. And you'll hear even conflicting advice from investors on how to think about building out your business. And at the end of the day, we're here to sense how strong of an entrepreneur you are and why you're the best person to be positioned in this market to execute on your plan. And that isn't tied to your valuation, because your valuation should be it's a lagging indicator of success at the end of the day, right? Because that's something that the investors put on you. Even the public markets, once you get to that IPO stage, right, and that's sort of all what we're all hoping for. You see CEOs talking about the difficulties of marketing to market every quarter and having to focus on delivering quarterly results when they actually just want to execute on longer term mission that the public markets may not be able to price correctly today. So that's why when you're in the private market, still not public as a company, you can have the leeway to execute on a vision. And I wouldn't think too much about what your valuation is today in terms of determining your product roadmap or your execution strategy. So I hope that's helpful to Emily Lisfield. Feel free to DM me and expand upon this. I'll just give a couple of seconds for these questions to come in as well. I see one from Miss Lisa Wang. She's asking, what are the usual minimum KPIs that a startup in the digital media space should have in order to start approaching VCs? So for example, monthly active users, etc. Oh, and this is a question asked by the founder of Call Out on YouTube. Thanks, Lisa. So I had some technical difficulties with the storm, so thanks for bearing with me. In terms of KPIs, and this is a question that's asked me often, and I guess I can't emphasize this enough, that it's not really about the balance of what your metrics are today. So it's not the snapshot of the metrics, but really the growth rate of your metrics. So rather than ask me what is the best KPI to have today, I would rather see, did you grow 100% month over month? Whether it's traffic, whether it's the engagement access, and just take a step back in terms of KPIs. There has been a lot of material written on the internet about what it means to hone in on your high experience user. So your core user for your product, for your website, is someone that you think if you satisfy that person, everyone else should more easily follow, because that person has the highest standards for what you're offering. So if I'm a food website and I'm trying to capture the foodies, I want the person who's aware of all other food websites coming to my website and be that engaged user and coming back. And if I can identify those people and develop a KPI around it, that is more helpful to me to hear your understanding of that process than sort of just asking what are the MAUs that are necessary. Those are more salient points, I agree, across websites, but the idea is to, what is a specific KPI that is the most useful for your company, and has that grown extraordinarily in the past couple months? And typically on the institutional seed side, we like to, from generally what I've heard, we like to invest in a company, at least in digital media space, that's post-launch. So pre-launch is difficult to have those numbers, and that's where really you'll get the most benefit from the angel stage. And also avoid that dilution that could happen and the heavy leverage that the investor would have if you're still so early. But with a couple of metrics on say the publisher side, I can throw out, as an anchor what we've seen. So NextGen publishers, and we're investors in terms of BDMI in publishers such as Inverse, which is a millennial male-focused publisher, in Mike.com, which is a political news publisher for millennials, also delving into other categories. So it's Click Media Group, which is Who, What, Where, and call outs to our portfolio companies. But these companies is because the founders had some unique angle and platform and history of building out publisher companies. We knew they knew how to execute on either the sales side of things or building out the traffic. And if traffic growth wasn't so important in the beginning, it's because their sales strategy, we knew they could execute. So it's more about, there's so much more beyond just what KPIs are necessary in terms of approaching investors in the earlier stage. And I would say, just to give you a sense, maybe a couple million monthly active uniques is sufficient for a Series A round, although we've definitely seen companies who have raised zero institutional funding and go out for initially a large round, say 3 or 4 million monthly uniques. And that's not an uncommon story. So, it's really about the growth rate and how you're seeing your vision, how you're seeing your high experience user. And so let's see, another question that's coming in. Yin is asking, I believe on behalf of someone, what is a specific KPI for your company that has grown significantly over time? I think that's more of a quote, right? So that's more of a quote. Apologize. I think I understood that as a question. Yeah, let me know if I got that wrong. But if that's a quote on my end, yes, completely agree with myself, naturally. So it looks like we're 6 minutes away from the end. Again, I'm Mary Liu with Bertelsmann Digital Media Investments. We're an early stage seed, Series A, Series B fund, and I'm excited to be a part of the SheWorx community and try to share as much knowledge as I can on the companies that we've seen in terms of what helps them get that funding round closed. The last topic I have here, and again, please feel free to interrupt with questions as well. And I'll just introduce the last topic, and I think there's another question that came in on the Slack channel. So the last topic that I'll cover are unique terms in the corporate VC space or the strategic VC space. I would just have in mind as you begin to fundraise and as you start thinking about taking venture money. So just to pause there, and before we go into that, there's a question that came in on, can you give an example of a company that did better going down the non-VC route? Yes, there's a lot of companies that did really well. And I guess I'll just name a couple that are just really well known in the space that took no money. There's a company in Chicago in the healthcare space called Complex Media. They are a darling, really, of the industry, I think, in delivering advertising supported content to point of care physicians' offices, and they've been able to build this huge business and didn't take any VC money and have avoided venture capital interest for the longest time. And ultimately, for companies like that, those are the companies that I think the larger and later stage private equity funds are trying to seek out. And there are many, many examples of businesses that don't have to take VC money, avoid the hype of high valuations, and then are able to cash out as founders later on in the game. There's a lot of examples there, and I'm happy to sort of talk through some of those one-on-one if you're interested, and sort of talk through some of the companies that I've seen that have uniquely built incredible businesses without taking VC funding. And just in the last couple minutes or so, briefly on some of the unique terms that we've seen and have heard of, just to be helpful for you as an entrepreneur as you're thinking about taking strategic money. And just to stop here, just to emphasize, to take a step back, there are always trade-offs to the situation you're in terms of working with a financial VC or working with a strategic VC. Just to emphasize, for us as BDMI, we like to see ourselves as a financial VC with the strategic umbrella of Bertelsmann over us, where you have the option as an entrepreneur to work with them if you like, and develop partnerships with them if you like, and exit to them if you like. However, that process is up to you as an entrepreneur, and that's why we think our setup is very optimal for aligning the incentives of us as investors with you as an entrepreneur, with best of both worlds possibilities of working with Bertelsmann. That's just, I mean, of course, I believe that that's a really great structure, but there are others who would say, a strategic VC with terms that could lead to increased ownership. So that's a path to control mentality. If you want to exit to a specific large media company or specific large tech company, those are great terms to take. But it's just important for founders to be aware of them and not be taken off guard as you look at the range of investors that you could potentially work with. Keep in mind that it's really important to have a great legal counsel, especially in the beginning in your first 2 fundraisers, to walk you through the terms and help you understand the different preferences that a strategic VC may want, the different blocking rights, or the different information rights that could potentially cap your exit. It's in the VC space, I'm operating under the assumption that you want to hit that home run, that $1 billion exit. If that's not your goal, then venture capital money may not be the best route for you. So most of the venture capitalists you'll be speaking with are operating under the assumption that you will want that $1 billion exit. And if you don't communicate that, that may not be a fund returner investment. Just be transparent on some of the terms that are used out there. And it's key to understand the differences between working with that strategic VC and a financial VC. And there are many trade-offs on that. And it sounds like we're running out of time here. So, in anything that we discussed today, I'm at mary@bdmifund.com. Feel free to reach out. I'm always open to the SheWorx community. Lisa and Ian have built such a great, supportive, caring space that I'm so honored to be able to help out here. And just it seems like one of the another question, we'll end on this question that came in from Jessica Kim on Twitter. How do you see video impacting the media space? And this is related to Kimberly Taylor's question. Ariana Huffington's Thrive Global is merging e-commerce with media very seamlessly. What do you think about that model? So, wow, way to touch on things that, I'm personally very excited about, how e-commerce plays into media and how video plays into media. You see the explosion of video, first and foremost, with some of the companies coming out like Now This, A+, and BuzzFeed diving into video. It's incredibly important for digital media companies now to have a video strategy. I think it speaks to the behavior of consumers and it's really meeting users where they are and giving them more visual experience. You also see a natural progression from text to articles and images to video. They've become more and more immersive. And if anything, we are seeing companies who are experimenting with 360-degree virtual reality experiences on their videos, where you can not only watch the video, but swipe through and explore the immersive qualities of that video. So that's a very interesting space to me, is how interactivity and engagement will only increase through these tools and platforms that publishers have access to. And just briefly on e-commerce, so that's a interesting marriage. There are folks that, and we've heard research that have shown, sometimes it's hard to say that when you have the reading intent, then that you will be able to transition to the buying intent on a website or on an app. And we have seen many companies who have tried to solve that by having a buyable video sort of website where you go and shop by watching videos, like a QVC for millennials. And e-commerce, in terms of what Ariana Huffington's trying to do, that could be something that, if you can push content through, if you can push products through content, that could be very powerful. A great example of that, is Goop. It's a website that Gwyneth Paltrow has, and if you read her content, it seamlessly integrates what she says and what she believes in with the products that she wants to push. And that e-commerce driven by content is there's a whole tagline for that actually in the category that investors think about, called content community commerce. Because when you build out that content and e-commerce together, you're trying to encourage a community of users to come together and not only read and connect on the material, but also connect on the products that can be bought. And those conversion rates and sort of understanding the process for that is really key. And just to end on some of the exits that have developed, or companies have exited well on those strategies. A darling of the industry is Dollar Shave Club, who developed a video around their product, and that video went viral, and ultimately it was one of the initial triggers of their mass appeal and success for subscription raisers. And now we're seeing more and more companies dive into video and content to help them build a brand to sell product. And ultimately, it comes down to building a brand, to building a loyalty with the customers that they identify with. And there are various themes and trends. I'm happy to go into any further, but it looks like we're all out of time. And hopefully we ended on a high note with this discussion of media and commerce and what it means to build loyalty and brand. And in terms of, just to wrap up, a challenge for the viewers as proposed by Lisa. So a challenge for you guys, and I think this is something you could take action on. Think about, if venture capital, I know when you're starting out a company, you have all these different things to think through. When you think about taking money, articulate to yourself, do you truly want that $1 billion exit? Or are you trying to build something that is more of a cash company, that's a mission that you believe in, that you don't really care about the exit? Having that focus is so key, because then when you communicate it to an investor, it comes out. And it comes out because, and that's important because you want to find the right partner. And when those, whether it's mission-driven, exit-driven, sort of motivations come out, you'll find the right partner, because then the investor who also sees eye to eye with you on that will be able to help you out, and will be able to come in and sort of jump into your vision as well. So being able to really have a crisp vision, and being clear with yourself, honestly, and not be carried away with the potential to have high valuations and the glory of being an entrepreneur. I mean, I understand it's not glorious, and I know all of you know that in the SheWorx community, but just being clear with yourself on the fundraising aspect and how you want to strategically connect your mission with the amount of money and the type of money that you want to take. Once you settle on that, I think that execution of investors will be really key. If you want to develop that strategy this week, that's a challenge. And if I can be helpful with that at all, I'm available. Again, I'm Mary Liu at BDMI, Bertelsmann Digital Media Investments, and it's been an incredible pleasure sharing with you. Thank you for all your questions, and look forward to being in touch.